Bitcoin and Ethereum together represent roughly 60 to 65% of the entire crypto market by capitalization. Most institutional allocators who are new to digital assets lump them together as crypto exposure. This is analytically imprecise and potentially costly. Bitcoin and Ethereum have different monetary architectures, different revenue models, different risk factors, and different correlation profiles to traditional assets. Investing in one without understanding its distinct thesis, and how it differs from the other, is equivalent to treating equities and corporate bonds as the same asset class because they both trade on exchanges. This video is not about which one is better. Both assets have legitimate institutional use cases. The goal is to equip portfolio managers, family office CIOs, and RIAs with a clean framework for assessing each on its own merits, so that allocation decisions are grounded in fundamentals rather than headline familiarity. The core distinction begins at the design level. Bitcoin was built to be one thing, a fixed supply monetary asset that requires no trust in any institution. Its protocol is intentionally resistant to change. Bitcoin developers view ossification as a feature, not a limitation. Ethereum, by contrast, was designed to be a general-purpose programmable platform. Smart contracts, decentralized applications, DeFi protocols, NFT markets, and increasingly real-world asset tokenization all settle on Ethereum. Its supply model is dynamic. After the merge in September 2022, Ethereum switched from proof-of-work to proof-of-stake, dramatically reducing new issuance and introducing a fee-burn mechanism that has made ETH supply net deflationary during periods of high network activity. For institutional investors, the distinction matters enormously. Bitcoin resembles gold in its monetary characteristics. Ethereum resembles infrastructure. Think of it as owning equity in a settlement network that generates fee revenue. 3 analytical lenses help institutional investors evaluate these assets within a portfolio framework. First, macro correlation. Bitcoin has increasingly behaved like a non-sovereign monetary store of value, correlating with gold during risk-off periods and serving as a hedge against dollar debasement narratives. Ethereum correlates more tightly with technology risk assets, reflecting investor sensitivity to network usage, developer activity, and application adoption. Second, the cash flow analogy. Bitcoin produces no yield and no revenue. It is a pure scarcity bet. Ethereum, through staking, generates approximately 3 to 4% annualized rewards paid in ETH. Institutional quants can model this analogously to a dividend, or apply discounted cash flow frameworks to projected network fee revenues. Third, regulatory risk profile. Bitcoin enjoys the clearest regulatory status of any digital asset, widely acknowledged as a commodity, with CFTC oversight broadly accepted. Ethereum has faced more scrutiny, though the SEC's approval of spot Ethereum ETFs in 2024 was a meaningful signal of regulatory accommodation. Over the 5-year period through 2024, Bitcoin and Ethereum produced broadly comparable total returns on an annualized basis, Bitcoin at approximately 62% and Ethereum at 58%. However, the risk-adjusted picture is meaningfully different. Ethereum exhibited annualized volatility of approximately 82% versus Bitcoin's 68%. Bitcoin's superior Sharpe ratio over this period reflects the combination of strong returns with somewhat lower volatility, consistent with its role as a macro asset with a narrower but better understood value proposition. It is worth noting that these numbers mask significant intracycle dispersion. Ethereum dramatically outperformed Bitcoin in the 2020 to 2021 bull market, driven by DeFi and NFT ecosystem expansion. Bitcoin outperformed in the early 2024 period, supported by ETF inflows and its clearer regulatory status. For portfolio construction, this cycle-dependent performance differential argues for evaluating both assets independently rather than choosing one as a proxy for the other. Bitcoin's value proposition is elegant in its simplicity: scarcity, security, decentralization. Ethereum's value proposition is more complex, and that complexity is its competitive advantage. The Ethereum settlement layer sits at the center of a multi-hundred-billion-dollar ecosystem. DeFi protocols, decentralized exchanges, lending markets, derivatives, hold over $80 billion in total value locked on Ethereum and its associated Layer 2 networks. Stablecoins, including USDC and USDT, settle hundreds of billions in transactions annually on Ethereum rails. Real-world asset tokenization, arguably the most significant institutional application of blockchain technology, has concentrated on Ethereum, with over $8 billion in tokenized assets live on-chain. Layer 2 networks like Arbitrum and Base extend Ethereum's capacity and reduce transaction costs tenfold, expanding the addressable use case without fragmenting security. For institutional investors, Ethereum represents a bet on programmable financial infrastructure, a position with fundamentally different return drivers than Bitcoin's monetary thesis. The distinct theses carry distinct risks that institutional risk managers must model separately. Bitcoin's primary institutional risk is the absence of yield. In an environment where investment-grade bonds offer 5%, holding a non-yielding asset requires high conviction in price appreciation or inflation hedge properties. Additionally, Bitcoin's protocol ossification, while a security feature, means the asset cannot adapt to changing technology landscapes. If a superior monetary protocol emerged with better privacy, scalability, or programmability, Bitcoin's first-mover advantage might erode. Ethereum carries execution risk. Its active development roadmap means each upgrade could introduce unforeseen vulnerabilities. Multiple competing smart contract platforms, Solana, Avalanche, and others, compete for developer mindshare and application deployment. Market share is not guaranteed. Both assets share regulatory reclassification risk. Specifically, any SEC determination that ETH constitutes a security would require significant restructuring of institutional custody arrangements and could trigger forced selling from ETF holders. For institutional allocators building a digital asset policy, the practical conclusion is that Bitcoin and Ethereum warrant separate evaluation and potentially separate allocations. Bitcoin belongs in the macro hedge bucket, sized relative to gold, inflation protection, and non-sovereign reserve asset exposure. Its risk model is relatively simple: fixed supply, no counterparty, pure market risk. Ethereum belongs in the productive technology infrastructure bucket, sized relative to exposure to digital financial infrastructure, settlement network growth, and programmatic asset markets. Its risk model is more complex: execution risk, competitive risk, and higher volatility. For institutions with a single crypto allocation line item, a 60% Bitcoin and 40% Ethereum split is a defensible starting point, capturing Bitcoin's monetary premium and Ethereum's ecosystem optionality without concentration in the more volatile emerging ecosystem assets. Regular rebalancing between the two also captures intracycle mean reversion, as leadership rotates between assets across market phases. Every week, Crypto Mechanics publishes analysis that treats digital assets the way they deserve to be treated, as complex financial instruments that reward serious study. If you are building institutional exposure to crypto and want frameworks that hold up in an investment committee, subscribe and join the community of professionals who take this asset class seriously.